When you break your arm, an X-ray gives you binary precision. It's a clean diagnostic process. You look at the film, you see the jagged white fracture, and the doctor just points to it and says, there it is. Broken.
It is entirely objective. The bones do not have a public relations team trying to convince the doctor that the fracture is actually a structural realignment strategy.
Right, exactly. But when you step into the world of corporate finance, of SEC filings and quarterly earnings calls, that objective X-ray machine just disappears. When you're looking at a $16 billion athletic apparel empire, the fractures aren't clearly lit. They are wrapped in layers of accounting bandages, obscured by adjusted metrics, and, just hidden behind management's optimistic forward guidance.
Which is precisely why we do not take press releases at face value. Our objective today is to strip away the marketing gloss and read the raw, unvarnished data for you.
Yeah, so today is Sunday, April 26, 2026, and we are putting Lululemon Athletica Inc., ticker symbol LULU, under the microscope. Lululemon is the undeniable powerhouse designer, distributor, and retailer of technical athletic apparel, footwear, and accessories. And we are diving directly into their newly released Q4 2025 earnings call and their full fiscal year 2025 annual report, the 10K, for the period ended February 1st, 2026.
Let us establish the immediate market reality first. Based on the provided stock quote of $143.80 and approximately 116.5 million outstanding shares, which includes both their common and exchangeable stock, Lululemon is currently sitting at a market capitalization of exactly $16.75 billion.
$16.75 billion. And, when you crack open this 10K, you can immediately see why the market assigns them that kind of weight. I mean, Lululemon leads with this incredible vision about creating transformative products, and they just posted an $11.1 billion record revenue year. For a brand built originally on yoga pants, crossing the $11 billion mark is just a monumental...
I see why that top-line number catches your eye. It is designed to. But as an auditor, my job is not to read the headline. It is to read the footnotes. Corporate vision statements about unlocking greater possibility do not pay the bills, and a record annual revenue number can easily mask severe underlying operational decay. To uncover the reality of that balance sheet, we will strictly follow a 9-point forensic structure. Move to point 1, top-line revenue and growth sustainability.
All right, well, let's unpack the revenue story then. As I mentioned, the total net revenue for fiscal year 2025 came in at $11.10 billion. That is up from $10.58 billion in FY 2024 and $9.61 billion in FY 2023. If we look at the trajectory adding roughly $1 billion a year in top-line sales, the company appears to be just a juggernaut moving steadily forward.
Peel back the annual number and look at the chronological timeline. Looking at the entire year as a single blended average is a trap. Management wants you to focus on the $11 billion because it smooths out the rough edges. But retail is a dynamic, highly seasonal environment. You cannot judge the health of a retailer by their average speed over 12 months.
Right, because you have to look at their momentum at the finish line.
Exactly. The finish line is the holiday season. So let's isolate the quarterly breakdown. In Q4 2025, the historically critical holiday quarter, Lululemon's revenue was $3.64 billion. In Q4 2024, it was $3.61 billion. When you do the math, that is a year-over-year holiday quarter growth of a mere 0.8%.
Wait, really? Less than 1% growth during the biggest shopping season of the entire year?
0.8%. The top line has effectively flatlined, and the context makes it even more severe. We know from their previous filings that Q3 2025 showed a 7.1% growth over Q3 2024.
Oh, wow. So they were growing at over 7% in the early fall, and by the time they reached the critical holiday window, they just hit a brick wall.
That is the operative reality. What does a 0.8% growth rate in the historically strongest quarter mean for a company priced for high growth? It signals a severe deceleration.
It's like watching a runner in a marathon. The overall race time, that annual $11.1 billion revenue figure, looks completely fine on the scoreboard because they banked so much time in the first 3 quarters. But if you actually sit in the stands and watch them run the final mile, which is Q4, they aren't sprinting. I mean, they are barely moving forward.
That is an accurate analogy. The overall race time looks okay because of a fast start, but the final mile was a desperate crawl. Now, put yourself in the shoes of an institutional investor. You are paying a premium valuation for a nearly $17 billion company based on the expectation of high growth. During the Q3 call, Kelvin McDonald, the CEO, explicitly stated that based on their guidance for 2025, they will achieve a compound annual growth rate in EPS of approximately 20% from 2018 to 2025.
Yeah, I remember reading that in the transcript. Management really anchored on that 20% historical CAGR narrative.
Because anchoring to the past is the best way to obscure the present. That optimistic 20% EPS CAGR narrative is attempting to distract from the reality that the forward windshield is showing sub 1% growth in their most important selling season.
Right. So if the top line is stalling in the most critical quarter, if the runner is crawling that final mile, basically, are they compensating by becoming more efficient, or is the bottom line bleeding too?
To answer that, we must forensically dissect the income statement. Moving to point 2, profitability and margin compression.
Let's get into it. Because you would logically assume that with an extra $500 million in total revenue for the year, going from $10.58 billion to $11.1 billion, the profit would, scale up proportionally. At the very least, you'd expect a healthy bump in gross profit.
You would assume that, yes. But the data tells a deeply concerning story. Gross profit for FY 2025 was $6.284 billion. That is virtually stagnant compared to $6.270 billion in FY 2024.
Wait, they generated $500 million more in sales, but only took home an extra $14 million in gross profit. I mean, where did the other $486 million go?
It was entirely consumed by the cost of doing business. The reason is found directly below revenue on the income statement. Cost of goods sold, or COGS. COGS surged from $4.31 billion in FY 2024 to $4.81 billion in FY 2025.
Wow.
That is a massive $500 million increase in the literal cost of manufacturing and transporting the product.
So literally every single extra dollar they made in sales this year basically cost them $1 to make. That completely eviscerates the gross margin. But it doesn't stop there, does it? What about the operating expenses, like the physical stores, the corporate salaries, the marketing?
It accelerates. Selling, general, and administrative expenses, SG&A, jumped from $3.76 billion to $4.06 billion. So not only did the physical product cost $500 million more to produce, but the overhead required to run the corporate machine expanded by $300 million.
The compounding effect of that has to be brutal on the bottom line.
It is. The result is a drastic fall in net income. Net income dropped from $1.81 billion in FY 2024 down to $1.579 billion in FY 2025.
So they are pushing way more volume out the door, working harder to hit that $11 billion vanity metric, but taking significantly less money to the bank.
And we must return to our quarterly timeline to see the true damage. If you isolate Q4 2025, I calculated the net income lands at roughly $587 million. Compare that to the prior year, Q4 2024, where they posted a net income of $748 million.
That is a stark 21% drop in net income during the holiday quarter. The top line grew by barely anything, 0.8%, and the bottom line collapsed by over 20%.
It is a profound structural failure for a premium brand, and the root cause was actually telegraphed by management. During the Q3 earnings call, management admitted that markdowns came in a little bit higher than expected.
When a corporate executive says something was a little bit higher than expected, that's usually just PR speak for, we had to significantly slash prices to get people to buy anything.
Precisely. Let me clinically explain this.
Fair.
Markdowns are destroying the gross margin. When you build a brand aura that allows you to sell a pair of leggings for $120, your entire margin structure relies on full price, organic demand.
Right, the premium pricing power.
Exactly. The moment you are forced to discount that premium product just to move volume, you prove that moving inventory is coming at the direct expense of profitability. The minimal 0.8% revenue growth wasn't organic demand, it was artificially induced by sales.
They essentially had to bribe the consumer to buy the product, and that bribery came straight out of the profit margin, which immediately makes me wonder if they are aggressively discounting to clear out inventory, just how much inventory is left sitting in the warehouses.
We find that answer by stepping off the income statement entirely. Moving to point 3, the balance sheet quality.
Okay, let's look at working capital and inventories. When you listen to the CEO on these earnings calls, he paints a very comforting picture. He mentioned the company has $1 billion in cash and no debt. If you are a casual listener, you hear that and think, oh, great, they have a fortress balance sheet.
That is, the narrative management is actively cultivating, but I am shutting that down. We need to audit the actual ledger. Yes, they hold cash, but the cash balance actually deteriorated. It fell from $1.9 $1.8 billion in 2025, down to $1.80 billion in 2026.
Okay, so they burned through nearly $200 million of liquidity. Where is that capital tying up?
It is trapped in unsold yoga pants. Inventories have ballooned. As of February 1st, 2026, inventories sit at $1.70 billion. That is a massive increase from $1.44 billion the prior year.
$1.7 billion in unsold apparel. That is just a staggering amount of inventory to be sitting on.
It represents an 18% inventory surge. Now, connect that 18% inventory growth against a backdrop of less than 5% annual revenue growth and only 0.8% Q4 growth.
Wow. Yeah, that math does not look good at all.
You do not intentionally build your inventory by 18% when your sales growth is effectively flatlined. The balance sheet is suffocating under the weight of this unsold product.
Let me push back on this a bit just to play devil's advocate for you. If I'm looking at their overall working capital, they report $4.26 billion in total current assets versus $1.88 billion in current liabilities. Doesn't that make it a fortress balance sheet, having twice as many assets as liabilities in the short term?
I will clinically retort that liquidity is an illusion if the assets making up that liquidity are fundamentally illiquid. Yes, they have $4.26 billion in current assets, but $1.7 billion of those assets are aging apparel.
And apparel isn't exactly a stable asset class like gold, right?
Technical apparel is highly perishable in the eyes of consumer trends. It will require further margin-crushing markdowns to clear. That $1.7 billion is a liability masquerading as an asset.
So the reported profit might look okay on paper, but the actual cash in the bank tells a completely different story. How is this inventory bloat affecting the actual cash generated by the business?
That brings us to the ultimate stress test. I demand your absolute attention for these forensic metrics. Moving to point 4, cash flow analysis and accruals.
This is the real detective work right here. You can legally massage an income statement, but cash flow is the undeniable truth.
We are going to calculate the true quality of Lululemon's earnings using two vital metrics: the accruals ratio and the free cash flow yield. Let's start with the accruals ratio using the balance sheet method.
For anyone who might not know, an accrual basically represents earnings that a company has recognized on their income statement, but that haven't actually translated into cash yet, right?
Precisely. We calculate the total balance sheet accruals by taking the change in current assets, which was a positive $282.39 million.
Okay, got it. $282.39 million.
We minus the change in cash, which was a negative $177.13 million.
Right, because cash shrank. So subtracting a negative means we add it back.
Correct. And then we minus the change in current liabilities, which was a positive $47.91 million. This yields total balance sheet accruals of exactly $411.61 million.
$411 million in accruals, and then we divide that by the assets.
We divide that by average total assets, which were $8.03 billion. The accruals ratio is exactly 5.12%.
5.12%. What does that specifically tell you as the lead auditor here?
This positive ratio indicates earnings are slightly higher than underlying cash generation. It is a clinical warning sign. Nearly $500 million of their claimed profit is locked up in non-cash items, mostly trapped in that ballooning inventory.
Okay, so what about the free cash flow yield?
While exact capital expenditures are obscured in the non-provided cash flow lines for this filing, we can use their net income of $1.579 billion as a proxy for operating cash flows.
And we weigh that against the market cap we mentioned earlier.
Exactly. Against the $16.75 billion market cap, this yields an optimistic maximum earnings, or free cash flow yield, of exactly 9.42%.
I mean, on the surface, a 9.42% theoretical yield seems pretty attractive. A nearly 10% return on the market cap in cash flow sounds solid.
It seems attractive, but adjusting for the $411 million in accruals, the true cash yield is significantly lower. The operative development is heavily reliant on non-cash working capital buildups.
They are essentially masking poor cash conversion by simply hoarding inventory. Which brings us to another area where management has historically tried to smooth over the rough edges.
We must audit that history. Moving to point 5, one-off effects and restructuring.
Let's talk about the Lululemon Studio debacle, formerly known as Mirror. We've been looking at the latest numbers, and the 10K reveals that impairments for 2024 and 2025 dropped to 0. So, I'm inclined to look at this and think, okay, they cleaned up the mess, 0 impairment charges lately, they cut their losses.
Do not let management off the hook for past capital destruction. You cannot evaluate the current executive team without forensically examining what they did just a few years ago.
The damage was immense, right? The 10K shows the historical impairments.
In 2022, they recorded an impairment of $407 million. In 2023, another $74.5 million.
$500 million of shareholder value just evaporated because they bought an at-home fitness startup right before the market crashed. But it's how they communicated it that's wild, right?
Exactly. Management historically used adjusted financial measures to exclude these massive losses from their non-GAAP EPS. They essentially told Wall Street, if you ignore the massive pile of money we burned, our operations are highly profitable.
Oh, the classic adjusted EPS trick.
I warn you to be highly skeptical of any future acquisitions. Lululemon's track record with capital allocation outside its core apparel business has been disastrous. They destroyed hundreds of millions in shareholder value.
You definitely have to audit the history, not just the present. Which brings us to where they are actually trying to generate revenue right now.
Moving to point 6, segment performance and geographic reliance.
So Lululemon's revenue is incredibly top-heavy geographically. If we look at the 2023 baseline, the Americas region generated 79% of their revenue, while China mainland generated just 10%.
The Americas region is the core. Now, recall the Q3 call with the CFO. She explicitly stated, "We began this work last year as we saw the U.S. business slow."
As we saw the U.S. business slow, that's a huge admission.
The core market is officially decelerating. This explains the 0.8% Q4 growth. Meanwhile, they are leaning hard into Asia. China mainland grew an astounding 67% in 2023.
Are they essentially flying a twin-engine plane where the massive U.S. engine providing 80% of the thrust is sputtering, and they are relying entirely on the smaller China engine running at 110% capacity just to stay in the air?
I agree clinically with that analogy. Relying on a single foreign market to mask domestic stagnation is a highly fragile operative model.
Right, because the Chinese market is notoriously volatile for Western brands. If consumer sentiment shifts or the macro environment cools, that secondary engine fails. And this desperation to reignite growth is driving their entire product strategy now.
It is a massive pivot. Moving to point 7, product creation and the newness strategy.
Management is targeting a 35% newness metric in their assortment. They are rolling out new web designs and store layouts to put this newness front and center. I mean, they talked a lot about the enthusiasm for the newness and these future core items driving growth.
Let me translate the corporate speak for you.
Right.
They are aggressively pivoting away from legacy items because core sales are shrinking.
Right. If a customer already owns 3 pairs of black leggings, you have to invent a completely new silhouette to get them to buy again.
But pushing 35% newness is incredibly risky. It exponentially increases inventory complexity.
Which ties right back to point 3's ballooning $1.7 billion inventory.
Exactly. And it increases markdown risk, tying back to point 2's margin compression. If the new styles miss the mark, the balance sheet will suffer further severe damage.
Which makes you wonder who is actually approving all these new risky designs.
Moving to point 8, management structure and governance.
The company is currently operating under a co-CEO structure, with Megan Frank as interim co-CEO and CFO, and Calvin McDonald. They also just appointed Chip Bergh, the former Levi Strauss CEO, to the board of directors. I actually find the addition of a seasoned retail veteran like Bergh to be pretty exciting for their governance.
My view remains uncompromising. A board member does not run daily operations. Why does a company with an $11 billion run rate need an interim co-CEO who is also the CFO?
It's a lot for one person.
Furthermore, having product design, merchandising, and brand all reporting directly to the CFO through a search process is a severe operational bottleneck.
Doesn't a CFO leading product design mean they will inevitably prioritize cost-cutting over actual innovation?
It is a major red flag for brand dilution. A CFO inherently protects margins. When the creative engine reports to the financial engine, the result is cost-engineered, uninspired products.
And when a premium brand loses its innovation, that premium pricing power just evaporates. Let's pull all of this together.
Moving to point 9, the forensic overall verdict.
We have to weigh Lululemon's financial health. We have fundamental strengths. The $1.8 billion cash balance, zero debt against massive weaknesses like margin compression, inventory bloat, and that 0.8% Q4 stagnation. What's the final synthesis?
I will deliver a clinical, uncompromising judgment. The quality earnings is deteriorating. Yes, they boast a high top-line number, but the chronological trend proves the core U.S. business is stalling at 0.8% holiday growth.
It's just barely moving.
The $1.7 billion inventory weight and the 5.12% accruals ratio mathematically suggest the operative development is not sustainably healthy in the short term. The profitability is being heavily subsidized by China's hypergrowth, which is notoriously volatile.
So the final verdict.
Lululemon is a highly solvent company with a strong balance sheet, but its income statement is flashing severe warning signs of a mature retailer struggling to justify a premium growth valuation.
That is incredibly eye-opening. Thank you to everyone listening for joining us on this deep dive. I want to leave you with one final thread to pull on your own. With the CFO temporarily running product design to drive this highly risky 35% newness metric and inventory already piling up to the ceiling, what happens to Lululemon's brand equity if this upcoming winter line requires massive, unprecedented discounting just to clear the warehouses? I mean, is the premium brand aura already starting to crack?
That is the crucial question moving forward.
Exactly. Look past the press releases and always audit the numbers yourselves. See you next time.